Welcome back, everyone. Been pretty busy recently, but I was reminded the other day by notification on my phone that I forgot to do something, and that was this video that I had said I would. Now, this video is about diamonds, and it is a bit of an up-to-date thing. Diamonds have not exactly been the best part of my portfolio, nor have they been the best part of this channel in that I have lost and failed to launch multiple presentations. But no more of that. Let's get to today's video. As I said, my time in the investment in diamonds has not been great. I entered the sector at a time when I thought it was a value play against some of the metals, base metals, and this proved to be potentially right on the metals, but wrong on the diamonds because it equally underperformed. Well, or poorly performed, I guess you could say. Anyway, so entered, and then there was a whole bunch of industry-specific things. The economy weakened, and the investment got, well, rocked for a few years, and still waiting on the fundamentals to prove out what I thought they would. For the second time here, and I'll get to that in a bit, I think we may be starting to see a bit of a move in the right direction and potentially have had seen the bottom a while ago. So as I said, a few years ago now, in 2019, I had higher hopes for the industry, and now this is 2 wrong years ago. I was thinking that the market would recognize the declining supply going out the next decade plus and start factoring in that into the road forward with the pricing road forward. You know, supply falling, demand inching higher, all the good stuff that you're looking for. At the same time, there were a lot of beaten up stocks, and there was insiders and institutions buying, and I thought that that was a positive sign across the industry. Mix that with prices being depressed, meaning very little supply coming online, anemic pipeline, and I thought it was supportive fundamentals. Until, well, among other things, the economic growth rate peaked in 2018 and fell really into 2019 when we had a bit of an industrial recession there. But there was a whole bunch of other things. There was the Hong Kong global disruptions, maybe you remember. There was India, there was a credit crisis type thing there. There was a whole bunch of people pulling money out of banks and investigations. And to those of you who may or may not be aware, that is, India is a big player in the diamond industry, and that led to a massive year of drawdowns, and that was in 2018. So, like I said, inventory drawdowns, and if the midstream, if the people who are buying the rough diamonds aren't buying, well, that's not good for prices, and they fell. So you may notice my voice change in a second, and that's because this next slide is actually from a video that I had made in early 2020 and didn't release for whatever reason. Maybe I forgot, maybe I wasn't feeling great about it, but anyway, I thought it was funny, and it's so typically something that would happen. And before this slide, I had spoke about feeling like, due to the things I just mentioned, I had won the Idiot of the Year award. Now, heading into 2020, the fundamentals look even stronger. Remember, the inventories draw down. There's a few indicators that have flipped. I'll get to those in a second, and I just want to buy more. However, I know that if the recession fears surge back up and everyone gets concerned again, or we go into recession, we'll have once again repeated the winning Idiot of the Year award, because I know that even if, well, especially if I dive in and buy more and things flip, probably won't go super well. So luckily, I didn't end up buying more. I had my concerns at the time, and I had, unfortunately, some remaining from my prior investment. Now, we all know what happened in 2020. It feels like it was yesterday, or at least a few weeks ago. But anyway, we had more supply decline supply decline. And it was another painful year of the industry, and miners don't like painful years because there's a limited number of them. And again, that got hurt, and the leverage didn't help either. Later in 2020, we had the Argyle mine, which is a massive mine, but mainly pink stones and poor quality diamonds. Those are two different things. Depleted. So the Argyle mine depleted. That's gone. And now we also had more inventory drawdowns in the midstream. There was slight builds in the minor inventory, but midstream, we've now had 2 large years in the past 3 of inventory drawdowns. So the only point, at least since pre-2008, where the inventory was at this level or lower was 2010, 2011, 2012. In 2010 and 2012, it was around where it is now. 2011, it was lower, and that was the all-time high in diamond prices. Now, I'm not saying we're going there now, but I'm saying the inventory has gotten to a point where it's fairly supportive of price at a time, where miners, well, are very endangered at this point. And now, for what it's worth, and as I mentioned in a few comments that I've said to people who've asked about diamonds, I'm kind of seeing the same thing that I was seeing at the beginning of 2020 before everything fell apart. And that is, the industry looks like it's healing. And how do things heal? Well, they heal downstream first, and then that travels back upstream. And you look at the retailers, they look like they're doing better. You look at the major diamond producers, doing better, 52-week highs, as are the prices for rough diamonds. And so I think we're back to where we were basically a year ago. And this time I'm guessing we'll see if I was actually could have been right about what I was thinking I was seeing. We'll see if I was right. If we continue upwards this time, I would have been right, I guess, but was very wrong, and maybe again, but thinking we're healing and progressing in the right direction. Now, one thing I do want to point out when it comes to supply and how the pricing works, I feel like the analogy to explain this is less of a copper mining analogy and more of a Bitcoin mining analogy, because the market size, the whatever billions of dollars the market is more like a prize pool. And that is what, I'm not an expert in Bitcoin mining, but, different parties put different amounts of work into the pool gets the reward, and the reward is split amongst the, all of the work that goes in, and all the miners and all the diamonds that come out. And in this case, the difference being that then the diamonds are split by, the hierarchy of exponential value, if you will. So the very big diamonds get a very high percentage, and the very small diamonds get very much less. But in any case, it works differently from many other commodities. And the growth in the prize pool, if you will, is very correlated to GDP growth, which is why this past year was terrible, and why hopefully going forward there's a long runway, hopefully, ahead. Now, I do want to address the bear case, because there are a number of naysayers around diamonds, around the pricing recovery. And so the main bear case that I hear commonly is around synthetics. Now, I have to say, it's possible. It's possible that the bears will be right, but I just want to run down what that would mean if they are. And to me, the argument boils down to, okay, synthetics are abundant or can be abundant, and so the price would move down to cost of production, which can be done very, very cheaply when compared with natural diamonds. So if this is true, it means that people think about them as equivalent. And if they do, then we can proceed to the next part. If they don't, well, then at some point the pricing mechanism breaks and they become two different things. One is, thought of as the beads, if you will. Not exactly, but kind of. So what it would mean if people were to consider the two, that is, a synthetic diamond and a real diamond, equivalent. Now, I believe there's many in the industry that have argued that people don't, and in the industry you would argue that. So it becomes a matter of personal opinion. But if people do consider the two equivalent, and it goes down to cost of production, that would mean that, in a few years, you could go out and buy a very special engagement ring, propose with a $20 ring, thus entering a whole new era of bravery in marriage. Does this sound likely? I mean, it's up to you, but it's what it would mean if the bear thesis proves correct. Now, the counter to this is kind of where I think the likelihood lies, in that the bulls will say that this thesis basically was intentional. I mean, that Lightbox, which is owned by De Beers, which is one of the biggest diamond producers in the world, along with Alrosa, entered the synthetic market in order to mass produce and crush the price of synthetics, making real diamonds special again. And I mean, to a degree, this kind of makes sense. It does seem like a risky strategy, but if you can make synthetic diamonds as rare as pebbles, well then, especially because you can tell them apart, it gives real ones their shine back. Moving back to real ones for a second, when we go to projects and in development and real diamond mine to bees, there's Star, which is in development. There's a handful of projects owned by majors, and there's very few explorers that are hoping to someday have something that will be a project, but will need a lot of money in the meantime. By and large, at today's prices, at last year's prices, well, heck, at last year's prices, but the prices over the last few years, it doesn't make sense for money to go into the ground. And so in the near term, I would think that, low prices need to get higher in order to incentivize, especially earlier stage development. So for now, the pipeline doesn't exist. Does it exist on Earth? Yes, but we don't know where it is at this point, and that's the whole point. As I said before, demand historically grows like GDP. And so if that has troughed last year, then anything going on henceforth in terms of GDP growth is positive for diamond pricing. And that's assuming sideways trajectory in supply. If supply declines, well, then you get a bit of an exponential, not high exponential, but exponential growth in price. If it's flat, just plain growth, and if it's slightly increases, lesser growth or decline. The question is, how did this past year disrupt, because there were many cuts, there was supply disruption. So how will that come back online, and how will that move forward? Before the disruption, the trajectory was a decline. Post the disruption, it was a big decline, and then a bit of a recovery, and then back to decline. So it really depends at what speed the existing production or the planned production comes back online. But it was assuming sideways is the near-term trajectory at least. This is sideways from a very low base. So I would think it would be supportive, but the amount of issues that have shown up in this market, unplanned, nothing would surprise me anymore. Is the industry dying? I'd like to think it isn't. But at the same time, when you look at the supply curve, if nothing changes, if the price does not dramatically or at least substantially increase, then the mining industry of diamonds will not last much longer. Anyway, that's it for today. Thanks for watching, everyone. Hope you enjoyed and hope you have better luck in diamonds than I, if at all, because remember, this is not investment advice. Until next time, have a great day.